Good morning, traders. Sorry for the delay in getting started this morning, the small delay. Welcome to the Tuesday, the 12th of April morning recap and outlook meeting and thought for the day. James's thought for the day. Stepping in for Steve this morning. Hello to all our traders around the world. Good morning to our US time zone traders. Good afternoon to our UK and European traders. And good evening to our Asian traders. Welcome to CPI Tuesday. It's funny because, throughout my trading career, there have been times when inflation, in fact, most of the time when that I've traded and managed traders, inflation hasn't been a problem. Of course, it is cyclical, and there were times, but when inflation wasn't a problem, like CPI, okay, it was a tier one data release, but it was always about non-farm payrolls. Welcome to non-farm Friday. That was the biggest day of the month. And while inflation is running so hot, CPI is the biggest number of the month, and it's out today at 8:30 a.m. in about Eastern time in about 56 minutes. So let's kick off with that. Let's have a look at the data calendar. ZEW out of Europe, out of Germany this morning. Oh, sorry, the Eurozone. This number here, this also used to be quite a big number for us when we were trading German government bonds, the German Bund, which essentially is the German 10-year government bond, the equivalent of the US 10-year Treasury bond, but it's also a benchmark for bonds in Europe in general. Now, all the Eurozone countries have their own bond markets, but in terms of, let's say, global strategy, if you're looking to express a view, say, long European bonds versus short US bonds, you would be long German government bond rather than a basket of the European bonds because it acts as a proxy for the rest of Europe. Anyway, just a side note there. We also had other big trades in when we were trading in Europe was the Bund and the Schatz, Bund, Schatz, and Bobble. So the Bobble's the 5-year, the Schatz is the 2-year, or round a basket of the 2-year. So that's the German bond market, and we had ZEW out this morning. But these numbers at the moment, particularly on a day like today when we have CPI, they're not going to have a massive impact on the market. The whole market is sitting on their hands this morning, waiting for this data release in the US at 8:30 Eastern time. And we'll have a bit more of a look at it in a moment. There isn't much else on the calendar today. A couple of an FOMC speaker, but really this is, the reason why we're listening to FOMC speakers is to figure out, what they're feeling about inflation. But given that we're going to actually have a look at what inflation is this morning, the focus today is all on this data release. So a proper tier one data release. We at Trade Day don't mandate that traders should be flat ahead of major data releases. But as a sensible, disciplined, risk managing trader, you absolutely should be flat. One of the temptations that I see in new, inexperienced traders is to put a position on before a major data release, expecting one, that they understand what this data is or can predict what it's going to be, which, of course, is laughable. We can get surprises either way, but they think they've spotted a trend, think they can predict it, and they think, it's going to be better than expected, so I'm going to put a position on in the market and I'm going to make very quick profits. And then one of the other sort of misconceptions we see is that people think that they can maybe put a position on or go in with a position and run a tight stop. So like the risk reward, whether they get it right or wrong, the risk reward is skewed heavily in their favor. I'll work a tight stop, and if I get it wrong, I'll just get stopped out for a few ticks. But if I get it right, it'll accelerate in my favor. And typically what happens is those stops get what we call run. So a stop is an order that actually, some traders don't realize this. If the market's trading 24 and you put a stop in at 20, you buy it at 24 and you think, if it comes off, I want to stop myself out at 20. Doesn't mean if it trades 20, you get filled at 20. What it means is if it trades 20, your stop gets triggered as a market order and you sell the next best available bid. Now, on data releases, by the time that order gets executed, that next best bid could be way below 20. If the market's really accelerating, the market's really liquid, and somebody's put a huge order in the order book to sweep the order book, then you can end up losing a lot more than you expect. So as I said, we don't mandate traders being flat like some prop groups. We want to empower the trader to make their own decisions. But over the years, my experience of trading full time and managing traders tells me that trying to go into a tier one data release with an open position is a fool's errand. Okay, so why are we focusing on CPI? We all know that CPI is running hot. The forecast is 8.4% for year on year, and the core 6.6%. Well, what it's going to tell us is the pace at which the Federal Reserve is going to act. Now traders are already starting to price in a 50 basis point hike in May. And so I think we'll if it comes in at 8.4% or slightly firmer, and the reason why I say slightly firmer than that, I'll come on to in a moment. But if we do, then that's just really sort of going to confirm it. We won't see much. But if we get a shock to the downside and it comes in significantly better than 8.4%, then that half point cut may be taken off the table, and we will see quite a quick and severe market reaction, a good one for stocks. But I'm going to wrap up the meeting, I think, looking at where we are on the charts, but also just running through a quick article on the US CPI number. Give us just to sort of like, I want to talk about not just the prediction, the forecast, which we can see is 8.4%, but what the market's pricing in, what it's expecting. That's what it's always about. That's how the market reacts, is what it's expecting, and what's potentially priced in ahead of the number. So we'll come to that on a moment. The other, obviously the big overriding news that's driving markets is the geopolitical front with the war in Ukraine. And that's dragging on. We talked about when I hosted the meeting last Tuesday. Let me just put up a chart here. Right. When I hosted the meeting last week, we were around here and we were talking about, perhaps this rally had been overdone, and, and that the war was starting to drag on, and, what initially looked like Russia backing down when it was pulling out of Kiev, or reducing its assault on Kiev, it was turning out to be a strategy where they seem to be building up a new ground offensive, but this time in the east. So they're moving all their troops to the east of Ukraine. I think they're going to try and take the port there. But what initially I think the market, this rally here got ahead of itself, and the market was starting to think, oh, Russia's losing the war in Ukraine, and the US are continuing to tighten through sanctions. Do you remember we talked about, like, Putin's not really the person or the type of person to back down, and if he feels like backed into a corner, he could escalate. And like the sanctions, the financial sanctions, obviously they're not good, and for Russia, and they are biting on the ground, which is part of the strategy to create sort of civil unrest amongst the population. And maybe they can rise up against their leader, but the sort of like Putin and his inner circle, they're prepared for it. Like, they're mentally prepared for these sanctions. To them, it's about taking Ukraine, and I don't think, unless they are, really are massively defeated in the war, there's going to be no let up here. And I think that started to bite into the markets, and what we saw here is we sort of kind of like fell over, maybe took some profit taking off the table from this rally, and the sentiment's basically been risk off since then, particularly as we've learned that Russia's amassing its troops in the east for a big offensive in the east. The geopolitical stance does not look good in Russia. So that's kind of what's happening there. The European countries are demanding that more weapons now be sent to Russia. So it seems like they're stepping away from diplomacy. Sorry, more weapons to Ukraine to help them defend against Russia. So that's a kind of moving shift from diplomacy into more a sort of military action. It's just not good. The war's escalating. So that's what's really sort of caused this sort of weakness and this sell-off in stocks. And we'll have a run through all the charts, towards the end of the meeting. And then the other thing, I just wanted to point out was the sort of strength of the dollar. The weekly market survey, live survey came out, and they were talking about the dollar in that survey. And sort of investors are confident about the future of the dollar for the year. They've got this sort of, the dollar's got this sort of great sort of I guess trifecta or sort of double sort of tailwind going on here. One of them is that the dollar is perceived to be a safe haven as an asset class. So in times of market stress or uncertainty, people buy dollar and sell risk currencies. So we see strength in the dollar for that reason, and also you have like rising interest rates, right? So it's a good reserve asset. So the dollar's strong at the moment, and likely to remain strong for the rest of the year for those of you trading currencies. Crypto looking a little weak. I actually had some puts on myself on BITO, which is a crypto ETF you can trade through Robinhood. I bought some puts earlier. Actually bought some last, I think it was Tuesday, and covered them on Friday or Thursday and Friday because they were expiring on Friday, and then I bought some more puts sort of late Friday. I think crypto's a little bit weaker, but that's just kind of in line with this general risk off sentiment in the market. Stock markets overnight are all sort of kind of like mixed bag. If anything, there's been a small bounce, but it's just really short covering ahead of CPI. See if I can see anything here. Right, so here's the stock market data. It's kind of like softer, generally softer, and Asia's softer, but that was following really the US softness yesterday. But when we look at the chart and sort of zoom in, we can see that we've had a little bit of a bounce here. This is the hour chart, and this is the hour chart for the Nasdaq. Had a little bit of a bounce. It's just really short covering ahead of CPI. Oil's got a little bit famous. I'm going to show you a chart on oil when we look at the charts. It's really interesting how technically it's trading. It's trading very well technically, oil. It's not an easy market to trade, particularly up at these levels. The daily ranges are high, a lot of volatility. But if you look at the major technical levels, it seems to be trading really, really well. And what we're seeing is potentially some easing off of COVID curbs in Shanghai, which is helping the price of oil today. And OPEC have warned that it's impossible to replace potential supply losses from Russia. So that's kind of added a bit of a bid to the oil market. There isn't much else out on oil. But if we go, let's have a look at the oil chart. I'm jumping back and forth today. Sorry about this, folks. I wanted to show you this oil chart. This is the daily. Look at this. Look at that downtrend. 1, 2, didn't quite make it here, but 3, 4, 5, 6, 7 times it's touched this downtrend. The more points it touches a downtrend, the stronger the trend, the more it's reinforced, and then we're almost sitting on it right now. So today is going to be an interesting day. Today, tomorrow, and see how things unravel with geopolitical things and Shanghai and COVID. But you can see here, it's also held these levels, these support and resistance levels. I'm trying to narrow it in. So these support and resistance levels are kind of major back from here. If I can get the data box up, you can see here what these lows were. 93, sort of 93.17, 92.34 here, 93.00. You can see so around here, sort of between sort of like, I would say, it looks like here on the chart, it's a bit lower actually, at 92.20 up to somewhere between 92.20 and 92.70. This level of support here, which this downward trend is almost, it didn't quite touch, but it certainly found a level of support here. And these levels of support that then turned into sort of levels of resistance were sitting right on those, as well as this downtrend. So a lot of resistance going on here. Interesting to see if oil sort of, continues to meet this resistance and falls over. But if it breaks, we could be seeing a rally back up to sort of the 104, 106 area, 104, $106 a barrel area for oil. So interesting to see how oil will play out today. We can have a look at the this is the hour. Let's zoom in on the hour. This is the hour chart. Really nice sort of downtrend there, again, sort of sitting on these levels. So we're going to see sorry, my mistake there. We were looking at the hour chart before, but this is the daily. Here we go. This is the daily. We can see sort of it's met this. This is the support that we saw on the hourly chart. So from a daily perspective, it's still got some sort of way to go between finding any sort of significant level of support and a sort of significant level of resistance. Maybe, as I said, if it can break through these highs here from the hourly, then maybe we'll head up back towards sort of this sort of level 103, 80. And what's that there? That's sort of 10. Delete that. So sort of around 106. So that's the daily. But this hourly chart looks really good in oil. Going to be interesting to see how the day plays out, whether it falls down or whether we get a breakthrough. And if we get a breakthrough, we could be looking to test sort of like 103, 104, 105 area, maybe as high as 106 in oil. I said I wanted to just jump in quickly to talk about sort of CPI and the expectation, because I was reading this article this morning and I thought it's pretty interesting. February reading was 7.9% year on year, and consumer inflation in the US is estimated to jump further in March to 8.4. The monthly reading is expected to reflect a rise of 1.2 after a 0.8 monthly increase in February. In short, inflation is expected to run hot, as it has been in the past few months. The Russia-Ukraine war has just exacerbated conditions globally, and the recent lockdown in Shanghai certainly won't help the situation. But what is the market anticipation coming into today, and where is the action going to be? Let's first take a look at the forecast distribution for today's estimate. So here's 8.4%. We can see that. That's kind of like where the expectation is. But look at this. And we can just see immediately underneath it. But as you can see, there's quite a skew towards being above 8.4% year on year. So there is quite a lot of expectation in the market that it's actually going to come in hotter than 8.4, 8.5, 8.6. So if it comes in here, yeah, it's a problem, but is it really going to impact price too much? Right, the expectation is 8.4. Comes in, a little bit worse. It comes in a little higher, or like worse than expected at 8.5 or 8.6. Is that going to be a massive create massive selling pressure in the equity market? Well, maybe not, because there actually is a bit of a skew up here in forecast, and these people will be positioning themselves for this kind of number anyway. So what they say here is, while this is just a forecast, it does point to some expectation that there are certain quarters of the market expecting higher inflation numbers. As such, I'd wager anything above 8.7 year on year or closer towards 9 year on year to produce a stronger beat. So what he's saying here in this article is it's really got to get sort of like into the 8.7, 8.8, 8.9 area before it's really going to impact prices in the market. This is just one man's, like a point of view, but it's interesting to sort of see how the expectation is skewed slightly to the so slightly above where the market's predicting the 8.4%, slightly above the forecast. So I just wanted to point that out. Um, Meanwhile, a reading closer towards 8% is like to help soothe the market a little as the inflation blow up isn't as uncontrollable as feared. So, I think, what we're looking at is 8.4, comes in a little bit hotter. It's not going to mean much. Comes in a little bit better, back down towards sort of 8.2, 8.1. And this guy says like 8% certainly. That's likely to really sort of like, bring some sort of bullishness to the market, make everybody feel like, okay, maybe with, inflation starting to become under control. And that's where the market's going to react. So just wanted to point that out. That's really it. As I said, on the data front, it's all eyes on inflation. On the geopolitical front, what's Russia's next step? I think we're expecting a big ground offensive in the east, a ground offensive in the east, and oil, trading technically well. If it breaks above its current levels of resistance, a continued push to the upside towards sort of 103 to 106 area. And that's about it. 6:54 is quite short for me. Let's wrap it up with thought for the day. Now, I cover this next part in one of our lessons on risk management on our free courses. But in case you haven't listened to it and in case you haven't listened to that course or you're joining us just recently and haven't had chances to work through the courses, I just want to talk a little bit on risk management and like a sort of an overarching philosophy that really helped me as a day trader. And it was taught to me very early on in my career, and that was try not to lose more in one day than you're capable of making in one day. Now, I want to just sort of like explain that a little bit in terms of what that might mean in actual numbers. So if you're day trading for a period of time, you'll start to get to a sense of what you're sort of capable of making given the risk limits you have. So, for example, let's say you're trading one lots, um, one lots and the occasional two lot, and you're pulling in sort of like £250 on a good day. 200 to $250. I'm sorry, I beg your pardon, on a good day. And you put sort of a few of these days together. You're like, yeah, this is good trading. This is I can make sort of 250, maybe even 275 trading one lots and two lots. When it goes wrong, when you start to lose money, you've got to try and stop yourself trading when you're down about that amount. And an important reason for it. And it's a lot of it's to do with motivation. So, we had one trader last week who put a sort of string of sort of 3 or 4 winning days together, sort of around those numbers, sort of $200, $220. And I think one day was a little bit better than that. They were down initially, and they got that loss back, and then ended up sort of around 250. But that's kind of where the account was hitting when they were finishing their trading day, and then they came in yesterday and they dropped sort of over $400. And I really felt for that trader because I know what's going through their mind right now. What's going through their mind, apart from like being angry at themselves for sort of like letting that loss sort of accumulate. But you really shouldn't be in a position where you are angry with yourself at the end of the day because as a day trader, there are going to be days where you lose money, and that's fine. Some days you just call the market wrong, and that's absolutely fine. But if you can, on those days, if that trader could have yesterday stopped themselves out at around $200 to $220, then coming into today, all they have to do is put like a good day together like they had last week, and they would have covered that loss. But now coming into today, facing a $400 loss, like they've got to have at least 2 days in a row where they have a good day before they even get sort of flat on the week, right? And that will take them into trading on Thursday before they've made any money. And that is like kind of, frustrating and sort of soul destroying as a trader, because you're like, oh my God, I've now got to work until Thursday to get flat. And that's assuming that trader puts a couple of good days together. What if that trader has a flat day today, or maybe loses a little bit today and then has a flat day tomorrow? They're going to end up working all week just to try and get flat, right? So it's really important when you're trading, when you've started to get a sense of what you're capable of making in one day, is not to lose more than that when you're having a bad day trading. Stop yourself out early. Right, there is a tendency for those on the evaluation challenge. Here's a quick tip for those, trying to pass the evaluation challenge, is that if you're on the beginner program, your daily stop's 500, and if you're on the advanced program, your daily stop's 1000. And there is a tendency for traders to say, okay, well, that's where I'll stop trading on the day. I mean, we see traders obviously struggle to stop at those levels and end up buying resets, but let's assume just for a second that everybody's capable and not getting caught up and just stopping at those levels. It does, just because we give you $500 to lose in one day or 1,000, depending on the program, doesn't mean you should be stopping there. You should be stopping according to what you're capable of making. So, it doesn't make any sense if you're trading one lots and you're making sort of 200 or 150 dollars a day, to, when you start losing, just keep trading until you've lost $498. And okay, you didn't fail the evaluation challenge, phew, but you're coming in the next day and you're sitting on a $498 loss, which is sort of 2 to 3 times more than you're capable of making. And it's going to take you so long to get those losses back. And it's going to be sort of soul destroying, like it's going to destroy your motivation. And not only that, it destroys your confidence because you've let your discipline go, and it destroys your it pushes you mentally into a place the next day where you start making poor trading decisions, right? Because you're now trying to fight the market, trying to get, sometimes we call it taking revenge on the market, or revenge trading. You took my money, I'm going to get my money back today type attitude, right? And that's not the right mental place to be in to make good, balanced, informed, risk managed, disciplined trading decisions, right? That's the mental place that you're in when you're emotional and you're making bad trading decisions. So it's as much, risk management is as much about managing your money, managing the risk, as it is about managing your emotions. Right? I want you to really think about that and try and sort of like look back through your trading, look back, given the size that you are trading at the moment, look back through your data and say, okay, what's a good day look like for me? Is it $200? Is it $300? Is it $400? If you're trading bigger size, is it $700? Is it $800? But that is the level when you start losing money that you're going to stop yourself trading on those losing days. And that way, when you come in the next day, you'll go, you're in a mental place saying, I'm capable of making yesterday's losses back today, as opposed to, I've now got to work 2 or 3 days to just get flat on the week, or just get these losses back before I can start moving forward. Don't put yourself in that position. I hope you found that useful. It's 7:02, CPI coming up in 27 minutes and something seconds. Good luck today. Have a great trading day.